Hello, everybody. My name is Nathan Byrd, founder of Acquicon, coming soon to Salt Lake City, and I'm joined here with Paul Burgon. Paul Burgon is the managing partner at Exit Ventures, a clean tech and sustainable VC fund that is creating strategic partnerships and strategic exits for its portfolio companies. He's also the co-chair of the Keiretsu Northwest and Rockies Clean Tech Committee, and Paul has spent most of his career as a corporate investor, leading over $3 billion of corporate acquisitions and divestitures, as well as the corporate venture capital investment startups. Paul has been a clean tech CEO with an exit and executive. He's also a board member in a European clean tech company, a partner in a hedge fund, and the CFO of a public company. Paul has extensive knowledge in a BSBA and an international executive MBA degree from Georgetown University. He and his wife Jill have 3 adult children. Paul and Jill live in Utah. Wow, it's quite the list. But I'm excited to dive into getting to know you a little bit better today as well.
I'm happy to be here. Thanks for having me.
Yeah. So we are going to be jumping into your specialty, which is primarily working with business owners that are going through exits, but there's so much to be had there. So let's just start with a little bit of your story of why you started to do what you do and why you love what you do.
Yeah, good question. Why? So honestly, just to be perfectly frank, I
Yeah.
was going to college and I was reading the Wall Street Journal. And at the time, it was big M&A, big merger and acquisition heyday time. There was an acquisition, it seems like, in the front page of the Wall Street Journal, like every other day. And as a college kid, it just seemed cool, right? It just
Yep.
seemed like, oh, I want to do that. I want to do that cool thing, right? It wasn't any more complicated than that. It was very simple. I was like reading the Wall Street Journal, and that sounded fun. I didn't know anybody in mergers and acquisitions. I didn't have a mentor. I just thought, yeah, that's what I want to do. So I started interviewing and eventually got a job where I was doing merger and acquisition due diligence at PricewaterhouseCoopers, and didn't realize that that was a very demanding job, very travel intensive, very hour intensive, 6, 7 days a week type of thing. And so I did that for 3 or 4 years, and honestly, I decided that I needed a break because it was exhausting. And so I decided to leverage the M&A experience and go more on the corporate side. Got a great corporate M&A job with a kind of a semi-sleepy public company, $350 million in revenues in Seattle. My parents lived in the Seattle area. My wife's parents lived in the Seattle area. We thought we bought a house on a golf course, and we're like, this is it. This is
life.
great. This is going to be the life. 4 months later, on my birthday, a company called Danaher shows up and acquires my employer, Fluke Electronics. And they said, yeah, this you're going to be a subsidiary now. You don't need to have your own, this company doesn't need to have its own M&A team. So Paul's redundant, but we could use him in DC at our company's headquarters, at the Danaher headquarters. And so I was like, well, either lose my job or go back to DC, where we had just come from 4 months previously. We had literally just moved from Washington, D.C. So we went from Washington, D.C. to Seattle to Washington, D.C. in like 6 months.
Back and forth.
Back and forth. But it was a great learning experience. So I took it. It was a great learning experience, great team, amazing company that was growing like nuts through mergers and acquisitions. I was very busy and got a lot of very good experience. After that, I was hooked.
Lots of transactions, and isn't that interesting how when life presents you with opportunities, it's either you say no or yes to it, and you just jump right in, and you learn along the way. That's what it sounds like with you. And
on-the-job training, man, it's great.
well, then you start to have an actual passion for what you do, and at times it can be difficult, right? Long hours, you're trying to go through, various paperwork as well as understanding relationships and things like that. So let's take us through the process of an actual acquisition, and how do you create that value within your company? I think that's one thing that a lot of people are aiming for, because now we're talking about the very end of a business right now,
Yeah.
but it starts in the very beginning.
Yeah. So are you talking from the buyer's perspective? How does the buyer create
So
the
let's look
value,
at from like the
or
owner's
from the
perspective,
seller's
and then we can
perspective?
go to the buyer's
Okay,
perspective.
great.
So now we're creating value with the
Right.
business, but how do we prep ourselves for an exit?
Great. My favorite saying for sellers is that you have to start years in advance of the actual exit date, of the actual sale date, and prepare for years before you actually sell the company in order to maximize value. So one takeaway from this entire conversation, you can't just say, hey, I'm going to put my company up for sale and get it done in a couple of months and create a lot of value. I mean, you could theoretically, but the way to create the most value by far is to start well in advance and prepare. And that's something that isn't widely recognized, that there is years of preparation for a maximum value, most successful kind of sale. So what I would, in a nutshell, to keep it brief, and then we can go into detail if you'd like, the steps that I would recommend is, number one, get the company to where you've achieved your strategic goals. If you feel like the technology, the company, the team can logically do X, Y, and Z, and you get to the point where you've done at least X and Y, and you're on the cusp of doing Z, right? Or you're into doing Z, then that's not a bad time to sell, and that's a good way to say, look, we're at the right point. But get your company there first, right? So take the time to go where you think you can logically go as a team, as a company, as a technology. Then you need to make sure the company is sellable, right? You have to take care of any open positions in management. Make sure there's not customer contracts that are about ready to expire. Make sure there's no open litigation or pending litigation or disputes with customers or suppliers, or heaven forbid, somebody on your own team.
Yes.
Right. Clean your house. Do the dirty dishes in the sink, and make sure everything's swept, mopped, and in presentable condition, just like you would sell your own house. Right. It's very much the same thing. Sell your house, get it cleaned up. Do the maintenance on your house. Same thing with your business. Get it cleaned up, do the maintenance, invest a little bit to make sure that there's some good growth opportunities coming that gets the buyer excited. You can't take everything off the table for yourself, because then you don't leave anything for the buyer to get excited about. So you leave a little bit on the table for the buyer to get excited about and say, yeah, we're in the process of capitalizing on this amazing opportunity, and we're not quite there yet, but that's for you, the buyer, to really dig into and to capture, right?
It's interesting how you've probably, I'm 35, so you probably got a few years on me, and I have I had a different perspective when you first get started in business, and you're like, I'm ready to take on this business. I'm ready to build this thing. And for you guys out there that are watching this and then also listening, you're probably in that position, or if you're not, then maybe you're a little older and you're about to exit. But for me, the perspective was, man, I'm going to put all this energy up front for the start. But then you're not looking to finish. You're so excited about the build that you're not being strategic in your exit. Can you speak to that specific topic when some of the people that you are mentoring, advising, to the business owners out there that maybe they're in the grind now and they're starting to see that it's going to take a lot more strategic planning for that?
Yeah. The key thing is, in achieving the exit, is being exitable. So in other words, what are you offering the buyers that they want and need? And this is part of the advanced preparation that I was talking about. You need to plan ahead. First, you need to understand, what do the buyers want and need, right? Who's the likely acquirers for my company? what do they want and need, and actually talk to them and say, how do you think about your technology expansion? How do you think about your sales channel expansion? How do you think about your customer expansion? How could I fit into this into the future, right? Don't be shy about having these conversations is my advice. And then plan ahead for what these various potential buyers want and need. Because a lot of times people will say, well, I'm ready to sell the business. Well, you may be ready to sell the business, but what if nobody's ready to buy it? Right?
It
You're stuck.
doesn't get bought.
You're stuck, right?
Yeah.
So it's a two-way street. And a lot of people don't understand and don't plan for, how do I close that loop so that the buyers are there, interested, and ready to buy. That's something that a lot of people don't think about that you need to plan for.
I like what you said earlier. At times, it's almost as if the seller is in a frantic position, where they don't really have leverage, when they just have to exit a company because they haven't put in those preparatory or prepared for that exit.
Mm-hmm.
And because you're gonna exit, and this is one of our previous speakers at Acquicon when we did the conference prior. You're gonna exit somehow, die
the right way or the wrong way.
Yeah, the wrong way, right? And it's interesting how when I've gone into due diligence with the acquisition of a company, many times the seller was, like I was saying, they're like, I have to sell. Like we've got to get out of this. And they really hadn't created additional value because they hadn't really put themselves in a strategic position to exit with the highest valuation.
Right.
It was just, hey,
that's
I'm
very
ready.
Common.
Well, that's interesting that, you have that perspective over time and scale. So share with us a little bit more about the journey of now, because we just did the seller, right? Or we're on to the buyer.
Mm-hmm.
So now as someone who's looking to buy an exitable company, what is your perspective there?
Yeah. What we looked for was synergies. So how do we create 1 + 1 = 5, right, with our existing operations? So there's two kinds of acquisitions. One, the buyer is getting into a brand new business line, and that's a very legitimate purpose, right? The other type of acquisition is what's typically called a bolt-on acquisition, and that's when the buyer already has operations that are similar, and they're looking to expand, to grow, to broaden the scope and the depth of their existing operations by bringing on, essentially a competitor or somebody that's already in the industry. So we would think about those two type of acquisitions: a new platform, we'd call it, or a bolt-on, in a little bit different ways. Usually, a new platform is considered to be usually a bigger type of business, a little bit more stable, very strong management team. Typically has 25, 50, 75 million in revenues. That's typically, for a corporate buyer, that's a new platform kind of deal. The bolt-on, let's talk about bolt-ons, because that's probably more applicable to people who are listening. That's, the corporate buyer is already in that business. They want to expand, they want to grow, they want to bring on talented people, and they want new customers, new technologies, new sales channels, new brands, right, to help them grow. And so we would look for synergies. We'd say, let's say, for example, that we've got electronic test equipment, which is one of the business lines within Danaher that I did acquisitions for. We have a certain type of equipment that tests electrical circuits and electrical currents and electrical equipment, and we're really good with low and medium voltage equipment. We don't sell high voltage testing equipment. And so we would say, in order to be a one-stop shop and to help our customers that actually want to be able to buy everything from us, because we've done our research, right? We've talked to our customers. We know that our customers would like to buy everything from us. Let's go out and look at a high voltage equipment acquisition. And there are companies that just do high voltage, and there are companies that do high and medium voltage. Would we want to buy some overlapping in medium and then get the high, or do we just want the high voltage? There's lots of pros and cons for both, and you have to decide which one's best for you. Let's just say that, we're going to buy a company that does high voltage only, because that's what we're missing. That's the piece that we're missing. So we go and we say, who has the most synergies with us? How can we get 1 + 1 = 5? Because their technology, maybe company A's technology is better with a technology portfolio that we already have. It fits in really well, hand in glove. Company B's doesn't. We'd have to do a whole bunch of R&D. We'd have to switch things around. We'd have to incur costs in order to bring them into the portfolio. So we say, hey, we can bring in Company A easily. Their customers really like their brand. Their customers really like their technology. And we can sell their products. Let's say for example, they sell $5 million worth of high voltage equipment. Well, we sell, let's just pick a number, $100 million globally, worldwide. And if we take that $5 million into our global sales channels, we can take the $5 million to $15 million of high voltage equipment. Well,
Almost immediately.
Almost immediately. Well, there you go. There's your 1 + 1 = 5, right? We get synergies of taking their existing product portfolio through our global sales channels. We create synergies. So that's a classic example of what the buyer is looking for, is how do we create almost instantaneous synergy. And it doesn't have to be instantaneous, but within the first year, how do we create that 1 + 1 = 5?
As a business owner, it is imperative that we know our buyers inside and out and structure our company, because again, it's either we exit because we get kicked out, we die, or we actually have a liquidation event that creates value for ourselves, for our family, for everyone else involved. But it takes the founder that responsibility to make sure that they know that buyer, they know the problem they're solving, but also they're strategic. I've heard you speak before about that specific topic. Can you go a little bit more in depth with how you've got to strategically structure and know your buyer in and out?
Mm-hmm. So it just building on what I was just saying is the seller needs to understand who the potential buyers are. Ideally, you would create partnerships with those strategics ahead of time, and this goes into the 2 or 3 year advanced preparation period before you actually sell. Is if you can create a partnership. So let's say that company A that does high voltage equipment, if they could create that partnership with a company and say, look, you can sell my products through your channels, and let's do this for a year, and let's date, essentially. Let's date. And the teams get along well. The customers love the product. They start to do a rebrand, so they white label the product for the big company's portfolio. Everything goes well. It goes off really well. Well, then, it's a logical acquisition to say things are going so well, we should buy you. Like there's no reason not to, right? That's how you get to know someone really well and understand the synergies that you bring. You don't have to do a partnership like that. I mean, some do, some don't, and there are pros and cons to each, and that's beyond the scope of this conversation. But at the very least, go to the conferences, trade conferences, go to the companies themselves, approach people on LinkedIn, contact them and say, look, I'm in the industry, I do this, I think, and give them, a thesis. I think I could be a good partner for you because of X, Y, and Z. Here's what we're doing. It's really exciting. It seems to me that it's very complementary to what you're doing. Can we sit down? Can we go to lunch? Can we go to dinner? And if you do that with 3 or 4 or 5 companies in your industry, you're going to very quickly understand who's the most synergistic fit for you and who's not. And you should be, my advice is as a seller, potential seller, knowing that you want an exit in a couple of years, you need to be aggressive in having those kind of lunches and dinners and coffee meetings to make sure that you understand the landscape of who is a potential buyer. Because if you're just throwing darts at the wall when it's time to sell,
good luck.
Good luck. Doesn't always go very well.
I look at it like this. It's funny. It's like water. We don't drink, if we drink water before we're thirsty or after we're thirsty. You know what I mean? you're basically
Mm-hmm.
dehydrated.
Uh-huh.
It's the same thing with
Yeah, it's
capital.
too
It's the
late.
same thing
It's
with building
yeah,
your
yeah,
business. The
right.
same thing with building your network and your relationships. It's really too late. You know, if you get to the end, now you're in a frantic standpoint,
Mm-hmm.
and now you're a seller that is going to get less value for your company
Because you didn't
based
prepare.
on
Yeah,
zero leverage.
yeah, you didn't prepare.
Man, this is interesting. Well, I hope you guys are enjoying this so far. We're with Paul Burgon here, professional with the exits of companies. Share with us, again, from more of a buyer's perspective, but then also actually real quick, I had a question in regards to the intellectual property and making sure that you have protection over the value that you've created as a potential seller to the buyer. So can you explain a little bit about how you do that?
And in terms of how the buyer evaluates the IP.
So if I'm reaching out to people, but then they immediately look to see that I have something, or yeah, exactly. So let's just put a value, but also let's be strategic on how we interact with that company.
Yeah. So the key to remember is patents and other IP know-how. Typically, it's usually patents and know-how. It's important to differentiate yourself as much as you can versus your competitors, and patents can be important in helping you create value that differentiates you. However, there's an asterisk there.
However,
a lot of IP, a lot of patents that I've seen are not necessarily what I would call blocking patents. Do they prevent someone from competing with you in a certain aspect of the functionality or price, cost of your product? There's a lot of patents out there that are like, yeah, there's 3 ways to do things. Let's say there's 3 ways to make a widget, and you've got a patent on one of them. Well, that's fine, but there's 2 other ways to do it that are more or less the same cost base, more or less the same functionality. So the fact that you have a patent on method A, but there's method B and C that also work, it's not really worth much, right? And so what a buyer looks for is, how does your patent, in this case a patent or know-how, differentiate you in terms of functionality, cost, ease of use, innovation, and value proposition, right? Bottom line is what value proposition does that give you that it doesn't enable someone else to copy and replicate? And that's the key. The other thing, that the ugly truth in patents is oftentimes, large corporations will infringe on your patents either knowingly or unknowingly, sometimes both, and in different situations. And they just say, hey, you're a small company. I'm going to do whatever the bleep I want, and you're going to have to sue me. And you don't have the resources to sue me, so good luck with that, right? So patents have value, and know-how has value, but it's not a panacea, right? And so entrepreneurs, business owners need to balance and understand and balance, right? Am I going to spend $10 million that I really don't have in order to get this, series of patents, this big, huge patent family developed, when, it may or may not be differentiating, right? Like, you have to, before you spend that money, this is my advice to entrepreneurs, before you spend a ton of money to say, look, I've got to get a patent family or a patent, understand how it's differentiating you, how it's unique, how it blocks competition, and does it block competition in a certain way, or does it provide you a cost advantage? And if it doesn't really do that, you got to think about the ROI of that, and versus the ROI of better marketing, better branding, better customer acquisition strategies, right? Better other technologies in terms of software development, et cetera. That's
good.
That's like hard brass knuckles kind of advice that you gotta think about carefully.
In regards to the scenario of you're about to you're getting to an exit within your company, but also from your personal standpoint and the amount of deals that you've done, has there been some trends that you're noticing with people that they fail to they fail to cover, dot their I's, cross their T's in some areas. Are there some areas that stand out more than not within the exit process?
Um, there's a couple that we've already talked about, which is plan ahead
Yes.
and understand your buyers. Those are two
really important.
key ones that are often missed. The other thing I would say is it's worth it to pay a little bit more for advisors that really know what they're doing. Investment bankers and lawyers that have a lot of experience in selling a company, ideally in your own industry. Now, they don't have to have, you don't have to have a lawyer who knows your industry cold. It's better if you do. You don't have to have an investment banker that knows your industry, perfectly well and has done 25 deals in your industry, but it's better if they have. So, but the bottom line is that you will get better terms, you'll probably get a better price, and the process will go more smoothly and will have less risk if you have a team of advisors who really understand what they're doing. They're very experienced in selling a company, and ideally they know your industry and the pitfalls and the things, the minefields where in your industry. Like if they know that and you've got good advisors, you're probably going to pay 20 to 30% more than a average typical investment banker or lawyer. I'd say it's worth it because they're not going to take advantage of you. There's a lot of corporations that buy small businesses from entrepreneurs who have worked their whole lives to build value. And then the large corporations with their team of very sophisticated corporate development professionals like I used to be and very sophisticated lawyers can take advantage of an entrepreneur who hires a lawyer or an investment banker that isn't that good.
Well, I like the seat that you're sitting in right now. And I think, the reason why I say that is because now you can help the entrepreneur understand some of these things that they may not know as much, going into a potential exit with that company. Well, this has been very informational, educational, but also a little inspiring as well from a business standpoint. Can you share with us briefly what you're excited about, what you're working on, and then also for those out there, how can they either get a hold of you, and then how can they support you?
Sure. So my day job is Exit Ventures. We're a VC firm, an early stage VC firm that focuses on strategic exits, more specifically creating strategic exits for our portfolio companies of climate tech startups. We're focusing on climate tech for this fund because that's what I've done and what I've invested in and what I've bought for a big part of my career. And I've run a startup. I've been on the board of water technology company. I've run a startup with in recycling and bought a lot of businesses in the climate tech industry. So we're leveraging that, and we're leveraging my corporate investing experience to, like I say, be very proactive with our startups in our portfolio to deliberately, proactively take the steps needed in order to maximize their exit value. And that's fun, right? So I'm a fund manager. I get to invest in amazing companies with amazing teams. I get to look at the technology evolution of what's going on in electrical power generation and decarbonization and single-use plastic replacement. There's a lot going on. And it's not driven by an administration. People say, well, what happens with a new change of administration? It's not gonna make a big difference. What's driving the industry is people want to replace plastic. People need more power for data centers, right? People need large-scale industrial batteries for high growth industries, including data centers, but a lot of other things as well. There's a lot, when you think about the rise of EVs and solar and wind and industrial batteries and data centers and power and grid upgrades, it's about a, I don't know, $6-7 trillion market, just a little small.
You're like, just 1%.
Just 6 or 7 trillion, probably, depending on the estimates, it's a lot bigger than that. So that's what I'm doing. That's what's fun. people can if you have a climate tech startup that's got some amazing technology, I'd love to meet you. If you're an investor that wants to be involved with a fund that proactively creates strategic exits for our portfolio companies and uses best practices in order to do that and create a lot of value at the startup, but also for our investors. So if that's the case, then we've got a great fund for you to invest in as well. So that's my day job. That's my passion. That's what we're working on. We're very excited about it.
Well, one thing I'm excited about is having you as a guest speaker at the Acquisition Conference 2025, Salt Lake City. We're building the conference to bring you guys out there the most value with individuals just like Paul that has extensive knowledge, experience, and really wisdom to be able to help you as the founder of that business that you were saying, help you create the most value within your business and not just be left with something that you're having to frantically sell off, just like what we were saying earlier. I mean, we really believe that the hard work that is put into the growth of a business should be rewarded. And if it isn't, then why are you working?
Right. What are you working for?
You know,
Right.
and that's the conversations we're going to have in the room at Acquisition Conference. And again, thank you so much for joining us on that. But guys, if you want to attend Acquisition Conference, just go to acquicon.live and make sure to get your tickets. But also to learn more about Paul, we'll put all of his information in the comment section below, as well as on the YouTube channel. So thanks a lot, Paul.
I look forward to it. It's going to be a great conference, and I look forward to talking to everybody there.
Yes, sir.